Okay, for this video, I wanted to go over the IRS Form 8814, which is the parents' election to report their children's interest and dividend income on their 1040 tax return. So why does this situation arise? Well, generally, children are not required to file a tax return, right? If you're under 18, you're not working, and you have no income, then you don't have to file, right? Only your parents have to file. Where this situation arises is if the child has accounts set up in its name where it's earning investment income. So things like interest, dividends, capital gain distributions. It's common these days for parents to set up these accounts for their kids, usually for college savings or things like that. And so if there is income earned in that account and we reach certain thresholds, we have to report it and pay tax on it. Now, I've got the 8814 in front of us, which we'll go through with a full 1040 for the individual parent here. But I've also got a slide covering some of the rules here and what are your options as a parent if you have children that have investment income. So the 8814 kind of goes hand in hand with this, quote, kiddie tax issue that parents face. So under the federal tax rules, kiddie tax is imposed on unearned income of a dependent. All right, so this is interest, dividends, royalties, rents, capital gains, any types of passive income that is paid to a child, so a dependent, is potentially subject to this kiddie tax. Now, dependents must file a 1040 if their gross income is more than the standard deduction for the year, right? So it's $12,550 for 2021. Or if their gross unearned income was more than $1,100. Okay, so now if you have a dependent whose unearned income exceeds these thresholds here, the $1,100, they have two options, right? They can report their income on their own tax return. So you have a dependent child that actually files their own 1040 and then computes the kiddie tax calculation. Or you can have, assuming certain requirements are met, you can have the parent report all of this income on their return, and that's done on the 8814. Okay, so if you do that, then the child doesn't have to file their own 1040, so it saves you a tax filing. Now, what's important with this election to start with here is this election is only available if the amount of unearned income comprises only interest, dividends, and capital gain distributions, and the child's total income is under $11,000. So this income issue here, interest, dividends, and capital gain distributions, if, for example, your child has a brokerage account and there's stocks being traded in there, so you have capital gains from the sale of stocks, you can't make this election on the 8814. Okay, you're going to have to file a separate 1040 for that child. So again, this Form 8814 can only be used if the income that's being paid to the child is only interest, dividends, and capital gain distributions. Okay, so now let's look at the fact pattern that we're going to be going through here. So we have John Doe. He's a single father, a single individual taxpayer, so he's not filing as a married taxpayer. And he has one son, child name, who is 6 years of age. Now, when John's child was first born, he opened an investment account for his son, and he makes yearly contributions to the account, cash contributions, under the gift tax exclusion. And once the cash is deposited, it's then invested into a bunch of ETFs, right? ETFs, index funds. And these investments pay out interest, dividends, and capital gain distributions. Now, for this example, note that we are not saying that any actual trading occurred to have capital gains. Because remember, if we sold stock for capital gains, John could not be completing this 8814 and making the election to include the income on his return. He would have to file a separate 1040 for his son, who is only 6 years old. Okay, so again, this fact pattern is limited to just investing in stocks and bonds that pay out interest, dividends, and capital gains. So during the 2021 tax year, John gets the consolidated Form 1099 for his son's account, and it shows the account earned total investment income of $2,850. Now that $2,850 in cash that was deposited in comprised dividends of $2,700, of which $2,300 is qualified. Okay, so we had $2,700 in ordinary dividends, $2,300 qualified. So that means the difference there of $400 is non-qualified dividend income. Then the account had regular interest income of $50, so that's just federally taxable income. And there was a capital gain distribution amount of $100. Now note here, because the child's total unearned income is greater than $1,100, there is a tax filing obligation here, right? So the son can either file his own separate 1040, or John can elect to report this investment income on his return by attaching 8814. So that's what we're going to look at here. So now let's jump over to the return. So I've got a tax return here for John Doe, right? This is his 1040. And on the 1040, he has his son's information here, right? He's going to try to get the child tax credit. And then John has a salary of $96,500, and then he takes a standard deduction of $12,550. And then what we're going to be doing here is filling in the middle with John's children investment income, right? So that's where the 8814 comes into play. So if I jump down to the 8814 here, let's start going through the elements. So the information reported is pretty straightforward, right? Name of the taxpayer up here, and then the child's name and social security number. Now, box C says if more than one form is attached, check here. This would apply if you have multiple children that meet this income threshold. So you file one 8814 for each child. Okay, so we've got child name here, social security number. Okay, so part one is pretty straightforward, the first few line items here, right? We have to enter the child's taxable interest income, right? So this would be reported on 1099 INT, let's say. So there's that $50. And then lines 2A and 2B are the dividend amounts. So the total ordinary dividends, remember it's $2,700, and then of that piece is $2,300 qualified. Now remember, we're breaking these out because qualified dividends are generally subject to a lower tax rate, right? You get the long-term capital gains rate or lower depending on your income, versus the non-qualified portion of the ordinary income is just subject to the ordinary income tax rates, right? So it's not a favorable rate. Then on line 3, we have the capital gain distributions, right? So capital gain distributions are long-term capital gain distributions, so they are subject to the long-term capital gain rate. Now, line 4 here, add up the lines 1A, 2A, and 3. So we've got $2,850 of total income, right? That's the amount that we have reported on our 1099 here, right? So we got the $2,850, and then the various breakout of the amounts. Okay, so we've got our 2850 number. Now the base amount, 2200, is that exclusion, right? So the child gets the $1,100 standard deduction, right, for the unearned investment income, and then the amount that is subject to tax is going to be anything in excess of 2200. So that's effectively how this works. So that's why we have the 2200 amount, and then when we subtract the two, we have $650 of income. So what we have to do next in these remaining lines is figure out, okay, $650 is going to be the income inclusion for John, the parent, but obviously this is going to comprise different components, right? We're going to have $650 in income, but it's going to comprise interest, dividends, qualified dividends, and then capital gain distributions. And that is what is going on down here in line 7 through 10. Okay, so line 7 asks us divide line 2B by line 4, right? So 2B here is the qualified portion, 2,300, divided by the total income, 2,850 on line 4. We get this percentage. Then we do the same thing in line 8. We have divide line 3, the capital gain distribution amount, by line 4, 2,850, and then we get this following percentage. And then we multiply them through, right? So multiply line 6, which is 650. This is the amount of income inclusion, times line 7, so that 0.807 number, and then do the same thing for line 10, 650 times 0.035, and we get $23. So now what do these amounts mean? Well, the $23 is the portion that's going to be considered capital gain distribution. So of the $100, what we're saying is 650 in total income is going to be taxed. And then of this 650, $23 is going to be treated as the long-term capital gain distribution. And then the same thing goes for line 9 here, right? On line 9, what we're saying is that $525 is going to be treated as a qualified dividend distribution. So again, the 650 here, we're pulling out 525, which is going to be characterized as the qualified dividend income amount. Now, the last item here, right, subtract line 11 from line 6. This is the amount that's going to be treated as just regular ordinary income. And so what does this amount represent 102? 102 is effectively the non-qualified dividends and then the interest income. So remember, we have interest income up here of $50. We have $400 in the gap here, which is non-qualified dividend. And so non-qualified dividends and interest are subject to ordinary income tax rates. And so that is our ordinary income inclusion. Okay, so now quickly I want to go over these amounts and see where they flow through to the return for us. So let's start with the $525 and the $23 amount. So $525 is the qualified dividend amount. Okay, so if we go up to Schedule B, so Schedule B, where we report interest and dividends, the first line item here, there's our $525 of dividend income, ordinary dividend income. And then if we look on page 1, we can see up here we're reporting $525 of ordinary dividends, and then of that amount is the qualified piece, 525. Okay, so there's where we're getting our 525 in dividend income amount. Now let's go back to the 8814 and look at line 10. So remember, line 10, this is the long-term capital gain distribution amount. So line 10 of $23 is going to first be reported on Schedule D. Okay, so if we go to Schedule D, this is where we have our capital gains and losses. And then in Part 2 here, for the long-term capital gains and losses, on line 13, there is our $23 amount. And the software package that we use also inputs this little label there, Form 8814, so that you as the reader know that we are getting this from the Form 8814. Now, if we go back to the 8814, what is the last income inclusion amount we have? It's line 12, the other ordinary income. Now, what's interesting about this is the $102 isn't separated into interest or non-qualified dividends. It's just reported income. So the other income line item, if we scroll back up to the return here, so Schedule 1 is additional income and adjustments, and there we have the other income amount. So on Schedule 1 for additional income and adjustments, this is where you would have all these various types of things, right? Schedule C income, unemployment comp, and all the way down here in the catch-all, the other income, we would put $102 and then label it Form 8814. Okay, so that's how all those amounts are flowing through to the return. Now, if I go back to 8814, there's one last thing we need to cover here, and that is Part 2. So what is this going on right here in Part 2? Tax on the first $2,200 of interest and dividends. If your child receive any kind of income that's qualified dividends or capital gain distributions, you actually pay more tax instead of filing a separate return, because if the child is filing their own tax return, the amount of income that's earned between $1,100 and $2,200 is 10% if you make this election, right? However, if you were to file a separate return, the tax rate could be as low as 0, right? Because remember, long-term capital gains and qualified dividend income is taxed at a maximum of 20%, but it can be as low as 0 if you don't have a lot of income. So that's what they're trying to do here, is they're figuring out that John needs to include an additional, effectively a $110 surcharge, because he is not separately filing the return for his child. You can find more instruction on this in the 8814 instructions, but that's effectively what's going on here. And so in order to report this amount, the $110 is just added as an additional tax to John's total tax computation. And so if we look at his tax computation worksheet, this is the regular tax worksheet for John. The amount of taxes being computed based on his income is going to be $14,327, right? That's using the qualified dividend capital gain worksheet tables. And then there we have an additional $110 in tax that's due on the 8814. So the total taxes that John's going to be cutting a check for is that $14,437 amount. Okay, so that covers it for the 8814. I hope that was helpful. Again, if you should really assess whether it makes more sense for the child to file on their own turn versus do it this way with the inclusion. But again, in some cases, you have no choice. You have to file a separate tax return for your child if they have too much investment income over the thresholds, or if they have certain types of investment income beyond these three categories, right? Remember, this election can only be made if you have interests, dividends, and capital gain distributions. If there's anything else in unearned income that's being paid to your child, they've got to file a separate Form 1040. All right, thanks so much, and I look forward to seeing you again soon. Thank you.